Thank you very much. It's a real pleasure to be here, and I'm delighted to have gotten this invitation to speak with you today. So this institute, I'll share a compliment about. It's doing excellent work, very important work, and I appreciate the opportunity to share my perspectives as an economist and policymaker at such a setting. So today what I'm going to talk about is the turmoil that we experienced in 2007 and 2008 in financial markets, and some of the policies and regulations and laws that contributed to that, and what we've done since then. So for many of you, this may be a distant memory. It may seem like a distant memory at this point. Many of you may want it to be a more distant memory. I'm going to argue that our response to the crisis has failed to address what remains the most critical issue facing our financial system, and that's the fact that many institutions are deemed too big to fail. And I'd say more specifically, they're deemed too big to fail without a government-supported and funded rescue of their creditors. This is a tough topic. It's a serious topic, but I think it's one that's really important for our country. So I'll talk about a path forward, the best way I see to get out of this jam, and I'll be explaining that at the end. But before I go on, I have to issue the usual disclaimer, which is that the views expressed are my own and do not necessarily represent the views of my colleagues in the Federal Reserve System. So what's the nature of this problem? What is this problem? So in my view, it's best described as two mutually reinforcing conditions. And these conditions support each other, they reinforce each other, but they also seriously distort the incentives of financial market participants to monitor and control risk-taking by the people they do business with. So the first condition is that creditors of some financial institutions feel protected by an implicit government commitment of support should the institution become financially troubled. Now, this could take the form of lending or guarantees or some insurance for their liabilities or the like, but they feel support that is going to be coming. And the second condition is that policymakers often feel compelled to provide support to certain financial institutions and insulate creditors from losses. Now, the way in which the second condition reinforces the first should be pretty obvious. Instances of government intervention that actually do provide support, those reinforce creditors' expectations that it's going to happen again. And that dampens those creditors' incentives to contain risk-taking by the companies they're dealing with. This promotes financial firms of greater size, greater complexity, greater interconnectedness than we would otherwise see. It also encourages greater leverage and more reliance, and this is crucial, more reliance on highly liquid short-term funding. And that highly liquid funding is what proves so dangerous and crucial in a crisis. So the apparent fragility of modern financial market arrangements is not a force of nature. Instead, financial instability should be seen as a consequence of the moral hazard effect of official intervention. And if you take away nothing else from my remarks today, I'd like it to be this. So the first condition also reinforces the second. And this is something that's been less appreciated in the discussion of the crisis than I think it should. Creditor expectations of support often compel policymakers to act in the event of distress, because disappointing expectations of support by withholding it is going to provoke a sudden and very turbulent readjustment of investor expectations and beliefs about whether support would be forthcoming for other similar financial institutions. So for example, in facing Bear Stearns, if we did not bail out Bear Stearns and assist in that transaction, not protect the creditors, ensure that they got their money, then the fear is that investors would surmise, well, they won't bail out Morgan Stanley. They won't support Morgan Stanley either, and the chain would go. But this is a matter of whether the expectations of the government's intervention are going to be fulfilled or not. At times like that, facing that dilemma, concerns about exacerbating moral hazard, which are the natural risk of intervening, they take a back seat to the urgently felt need to stem the volatility that would result from disappointing expectations. So perceived guarantees on the part of financial markets encourage them to engage in fragile funding arrangements, and that induces interventions because disappointing those expectations leads to turmoil and sudden revisions in expectations about other institutions. And so we intervene, but that encourages further fragility. And this is the cycle we've been in. The ultimate result is taxpayer-funded subsidies to financial firms, and these are widely viewed as deeply unfair, and that's the problem. What we have is a fundamental flaw in the relationship between our government and our financial sector, and the impact of the flaw is growing. At the end of 1999, when I was research director, I asked a couple of our economists to measure this. The government safety net, so the financial liabilities that were perceived or to benefit from a government guarantee of support, covered 45% of the financial sector. So 45% of the financial sector's liabilities at the end of 1999 benefited from explicit or implicit support. So the explicit support would be things like deposit insurance or pension benefit guarantees. By the end of 2011, that had grown to 57%. And that was about the same size as it was in 2009. So it was about the same despite the fact that we'd put a lot of new regulations in place. And I think many of these new regulations are valuable and compared to where we were in 2009, but they haven't by themselves solved the too big to fail problem. Instead, I think we need measures to give market participants the incentive to implement resilient financial arrangements that end the expectation of government support. Dodd-Frank Act, as I'll describe, provides some important tools for us to do so, but I think further legislation would be helpful as well. This work won't be easy, and in some quarters it'll be very unpopular, but if we hope to make financial stability compatible with our democracy, I think we need to do these things. So, how did we get here? To quote the talking heads, the origins of too big to fail can be traced back to 1933. The Emergency Banking Act of that year marked the beginning of federal deposit insurance in our country. The act was signed after a tidal wave of bank failures between 1929 and 1933. More than a third of the country's 25,000 banks failed in that period. Depositor losses, disruption to payments were severe, enormously disruptive. At the time, the U.S. banking system was highly fragmented. Interstate branching was prohibited, and only 8 states and the District of Columbia allowed branching within their state or locality. This made that banks were usually very small, usually just one office, unit banking it was called, and they were unable to diversify risks across regions or head off runs by pooling funds, shifting funds from another branch to cover withdrawals. And so most parts of the country were served by banks that were pretty vulnerable to economic shocks. Now there's a popular account of this episode you might hear that holds that the crisis was caused by self-fulfilling depositor panic, that fearing that their bank might fail, people rushed to withdraw their funds, and by itself that actually brought the bank down. But modern scholarship has pointed in a different direction. It's concluded that the crisis was in fact the result of fundamental shocks to the solvency of the banking system. The Federal Reserve System allowed the money supply to collapse during that period, and the result was a severe deflation, 28% fall in the average price level over 3 years, and that drove many bank borrowers into default. Bank runs contributed to the decline in the money stock, but the Fed could have offset those effects through open market purchases. That is to say, without lending to specific banks. So the most striking evidence of this is that Canada, a country very similar to ours, suffered very similar economic shocks. Banking laws there allowed consolidation, and as a result there were no serious banking panics up through that period, and they didn't even have a central bank. We did, but they didn't. So without a central bank, they had no record of panics in that period. Legislators were very well aware that branching restrictions contributed to banking panics in the way I've outlined, but they didn't respond by eliminating the branching restrictions. The unit banking system was very popular with agrarian and populist political forces, and they lobbied instead for government-funded deposit insurance that would provide small banks with protection for their depositors. There was significant opposition. President Roosevelt was against it. Carter Glass, architect of the Act, Federal Reserve Act, but the supporters prevailed. And it wasn't until the 90s that we got open branching across state lines and within state lines. So the proponents of deposit insurance can't take all the blame for too big to fail. Beginning in 1970, the Fed and other regulators began to intervene in credit markets in ways that protected uninsured creditors of large financial institutions. So I'll name some highlights here. The railroad Penn Central defaulted on $82 million in commercial paper obligations, and the Fed responded by encouraging banks to borrow from the Fed to purchase the commercial paper of Penn Central and others to provide support to the securities market. In 1972, the FDIC gave $1.2 billion Bank of Commonwealth a $60 million line of credit to prevent its failure, to protect some uninsured creditors. In 1974, the Fed lent $1.7 billion to Franklin National Bank and assumed $725 million of its foreign exchange book. In 1984, probably most famously, the failing $40 billion bank, Continental Illinois, was able to borrow from the discount window, even as it was receiving a capital injection from the FDIC. The precedent set by these actions, along with many, many others, too numerous to name here, was not lost on financial market participants, as you might imagine. And it led many economists to be concerned about the issue of too big to fail, even before the recent crisis. So to name a prominent example, in 2004, Gary Stern, who was then the president of the Minneapolis Federal Reserve Bank, together with Ron Feldman, an executive VP at that bank, published a book titled Too Big to Fail, The Hazards of Bank Bailouts. And in it, they warned that the too big to fail problem is real, costly, and becoming more severe. Unfortunately, they were proven correct just a few short years later. Now, there have been a lot of popular accounts, even movies and made-for-TV miniseries about the financial crisis of 2007 and 8. So I'm not going to recount all the events, but I'm going to hit some highlights that are suggested by those two mutually reinforcing conditions that I referenced at the outset of my remarks. So beginning of it was in 2007, estimates of losses that were likely to be experienced on subprime mortgages rose significantly, and that caused investors to revise their assessments of financial entities that were deemed or known to be likely to be exposed to losses in subprime. Now, consequence of this was that the credit terms to those firms shifted adversely, deteriorated. The risk premia on their obligations in wholesale funding markets rose, and the maturity of the obligations they were able to issue and sell shrunk. They were only able to fund themselves for 5 days when they used to be able to get 30 or 60-day credit. This is, of course, how markets ought to react to something like this. But in August of 2007, the Federal Open Market Committee took its first step in response to the tumult by lowering the interest rate charged on discount window loans to banks and actively encouraging banks to borrow. Then in December 2007, in response to rising interest rates in interbank lending markets, again, banks were pulling away based on the creditworthiness they perceived in their counterparties. The Fed launched something called the Term Auction Facility, and this was a way to provide term loans to depository institutions on more favorable interest rates and terms than before. I think that it's fair to say the guiding principle behind these actions and others that followed by the Fed was that credit markets were malfunctioning and that the remedy was additional central bank lending. Arguably, however, market participants inferred that the Fed was standing by, ready to rescue the creditors of financial institutions that showed signs of distress, which actually occurred the following spring when the New York Fed helped finance the purchase of Bear Stearns by J.P. Morgan. These actions clearly reduced the incentives of other large financial institutions, such as Lehman Brothers, to strengthen their positions by raising additional equity or reducing their reliance on short-term funding. Capital markets were open to these large financial institutions prior to the fall of 2008, and that was demonstrated by the equity issuance that did actually occur. But not enough new capital was raised in that time period, that window that was open there. Apparently, the costliness of the shareholder dilution associated with new equity raises made it more attractive for financial firms to instead rely on the implied backstop of government support to get through. Now, I'll say from experience, policymakers were certainly aware that their actions might exacerbate moral hazard. And we can all understand the bias against inaction when faced with some unknown and potentially grave threat. But the distortion in banks' risk-taking incentives was viewed as a long-run issue, something that would affect us, maybe the next business cycle, maybe the next crisis years down the road. And that was to be thought of as traded off against the immediate value of cushioning an imminent blow to financial market functioning. So the crisis we've been through tells a different story. It wasn't just some different distant future crisis that was affected by the precedents that were set. It was the next chapter in the current crisis. Each new move to expand the use of Fed lending also had the effect of increasing expectations of official support in the months ahead. So during the crisis, and still today, many people view government-provided backstops to large financial institutions as a necessity to prevent financial system malfunctions. You've probably heard that central banks are supposed to act as a lender of last resort. And this idea is often attributed to Henry Thornton, a British economist who wrote an influential book on central banking in the 1980s, or more popularly, you may have heard about Walter Bagehot, B-A-G-E-H-O-T, pronounced Bagehot, a British essayist and journalist who wrote a book on central banking. It's very famous in the 1870s. Now, actually, neither of them used the term lender of last resort. That term doesn't appear in Google Books before 1930. I checked on Google Ngram. So their writings, though, are pretty instructive. When they were writing, lending by the central bank was the primary mechanism by which the Bank of England increased the circulating stock of money. Now, the stock of money then was paper notes and gold coins. And at times, the demand for gold coins and paper money rose. People wanted to get their money out of deposits in banks, and they wanted to. Same thing happened in U.S. banking crises in the late 1800s as well. So the way to get more money into circulation was for the central bank to lend to banks and let the money flow out. Their writings make clear that they were not recommending rescues for insolvent institutions. And so their prescriptions were really about monetary policy, not credit policy. And if you take another idea away, it's this distinction between the Federal Reserve providing a supply of monetary instruments to the economy in a sound way, and targeting credit at individual borrowers, ensuring that that credit gets somewhere in particular. So providing assets to the market makes perfect sense, and we can do that without lending to an individual institution. But credit policy is something else entirely. It's fiscal policy. So the Fed's emergency lending programs did not increase the net supply of liquid assets to the economy. In fact, the Fed's lending was offset by sales of Treasury securities so that the supply of currency plus reserves didn't increase. If we hadn't offset that, it would have increased the supply of money. It would have driven down interest rates. We did that later in 2008, but with Bear and the early lending programs, we were sterilizing them. We were offsetting them. These lending programs reallocated credit. Effectively, we had to sell Treasury securities to the public and use the money to lend to Bear Stearns or whoever. So it's as if we're doing fiscal policy. That's not what Thornton and Bagehot had in mind. Now, another idea you may have heard of, the idea that public backstops are a necessity, is often more broadly motivated by theoretical models that feature multiple equilibria. I won't go into that phrase any further. Or market segmentation that impede arbitrage between markets. And in these models, outcomes are inherently unstable or suboptimal without some sort of active government intervention. Now, I haven't found these models terribly persuasive. I could go into the details, but as accounts of the financial market phenomena that we were grappling with, they just don't seem realistic, because the critical frictions to market functioning that they rely on just don't seem realistic. They seem at odds with observations. Now, more broadly, the idea that financial instability is inherent rather than induced by sort of the reaction to government policy has to confront the fact that instances of instability are quite unevenly distributed across countries and across time. The big example of this is Canada. I mentioned Canada. U.S. and Canada, both in the 30s and earlier, had just tremendously different experiences. And if you want more information about this, there's a book by Charles Calamiris and Stephen Haber, who's of Stanford University, I think the political science department, that came out this week that documents this at great length. So, the government's main response in the aftermath of this crisis has been the Dodd-Frank Act. This is a 2,300-page piece of legislation. I'd like to read it to you now. And I don't think we have time. Sorry, we're not going to get to do it. So the Act places roughly 400 new rules in place. There's a new federal agency, a lot of hard work, even apart from the Act, a lot of hard work around the Federal Reserve System, the FDIC, other regulators has gone into this by really good people that are frontline supervisors in the banking system. But this Act fails to address the central problem. So one broad strategy of the Act is to prevent failure in the first place. So the Act provides for enhanced supervision of large financial institutions, stronger capital, liquidity requirements, periodic stress testing, counterparty credit limits, risk management requirements, a whole host of things to strengthen how they manage themselves to prevent too much risk from being taken on. Now, beefing those up is great. But these are ex ante, before the fact constraints on risk taking. The problem is that those are just not infallible. New opportunities for risk taking are always going to emerge as financial markets and economies evolve. And it's asking a lot, I think too much, of our frontline supervisors to substitute for well-aligned incentives. Moreover, stronger restraints on risk-taking increases the incentive for market participants to find a way to operate outside of the regulated banking industry. This is a regulatory bypass. And this is what's given rise to what's called the shadow banking sector. Bank-like activities conducted outside the legal confines of the banking industry. Shadow banking arrangements played a big role, as I'm sure you know, in this financial crisis. And paradoxically, some of the arrangements were the result of past financial regulations intended to remedy what was wrong after the last crisis. I think expanding regulations to chase down fragility wherever it appears is not a promising strategy. The Dodd-Frank Act also creates a mechanism to resolve large financial institutions that become distressed despite enhanced supervision. Title II of the Act establishes what's called the Orderly Liquidation Authority, or OLA, and it gives the FDIC the ability, with the agreement of other financial regulators, to take a firm into receivership. The FDIC is able to borrow funds from the U.S. Treasury to make payments to creditors of the failed firm or to guarantee the liabilities of the failed firm. The funds are to be repaid from recoveries on the assets of the firm or from assessments against the largest, most complex financial companies. Now, the FDIC has to pay creditors at least what they receive in liquidation, but the Act does give the FDIC broad discretion to pay some creditors more than they would get in bankruptcy. Moreover, the ability to inject funds from the U.S. Treasury allows the FDIC to immediately pay off creditors whose claims would otherwise be subject to bankruptcy proceedings in which they have to wait, subject to delays, to sort out who gets what in bankruptcy. Short-term creditors are likely to believe, under this regime, that they will benefit from the FDIC's discretion, and that would, again, cause them to pay insufficient attention to risk and invest in financial funding arrangements that are fragile. If expectations of support for creditors of financially distressed institutions becomes widespread, then regulators are in the same box again. They're going to feel likely forced to provide support to those short-term creditors in order to avoid the turbulence of disappointing expectations. And so rather than ending too big to fail, I think Dodd-Frank is recreating these two mutually reinforcing conditions that define too big to fail. So if more regulation isn't the answer, what is? In my view, ending these two mutually reinforcing problems requires creating two alternative mutually reinforcing conditions. And the first would be that creditors do not expect government support in the event of financial distress. If we can achieve that, private sector financial firms and their creditors will have an incentive to avoid fragile financing arrangements, limit risk-taking, and thereby reduce the pressure for the government to intervene. And the second condition, of course, is that policymakers actually do allow financial institutions to fail without government support. If we can make unassisted failures manageable and the norm, then policymakers can credibly commit to foregoing rescues and thereby improve private sector incentives. So, how do we do this? There are several steps we can do to get there. First is to rigorously implement a provision of the Dodd-Frank Act that requires large and complex institutions to create resolution plans, also known as living wills. These are detailed plans that explain how a financial institution could be wound down under U.S. bankruptcy law without threatening the rest of the financial system or requiring a public bailout. The plans explain how to disentangle the many different legal entities that make up one of these large firms. Sometimes it's thousands. Under the Dodd-Frank Act, large banks and other systemically important firms have to submit these on an annual basis for review by the Fed and the FDIC. And the first wave of filers has made 2 rounds of submissions so far. This provides a structured approach for understanding what's likely to happen in the event that a large financial institution should fail. In contrast, in the past, policymakers found themselves with little or no preparatory work to draw on. In fact, resolution planning has proven valuable already by giving participating firms a more detailed understanding of their own legal structure. Many have used it to clean up that structure and close down unneeded legal entities that they didn't even know they had. More to the point, however, if resolution plans indicate that bankruptcy would pose a threat to the system as a whole, regulators can order changes to the structure and operations of a firm in order to make it resolvable in bankruptcy without government assistance. So the Fed and the FDIC can jointly determine that a plan is not credible or would not facilitate orderly resolution under the bankruptcy code, in which case the firm would be required to submit a revised plan to address the identified deficiencies. Resubmission could include changes to the funding strategy, changing to the business operations, the corporate structure in order to eliminate deficiencies. If the Fed and the FDIC jointly determine that the revised plan does not remedy those deficiencies, they can require more capital, they can increase liquidity requirements, they can restrict the growth, the activity, and the operations of the firm. In other words, we can work backwards from resolvability without turmoil or tears in bankruptcy, work backwards from there to what firms have to look like, how we have to reduce the fragility of these institutions. Now, this is going to look daunting because the immense scale and complexity of these companies. Indeed, this has led some to suggest that government-funded resolutions under Title II, this orderly liquidation authority, should be our main strategy for cases of financial distress. But I don't think a defeatist attitude is warranted here until we've tried it, working through Title I. Now, certainly the needed alterations in the structure and operations of large financial institutions are going to be unpopular, especially with the firms involved. They're not going to want to do that. And they're likely to involve reductions in the reliance on short-term funding and derivatives. And they're likely to involve the adoption of more easily severable subsidiary structures. But I think that these changes are feasible without sacrificing any of the inherent benefits that these institutions do provide to the economy. I think the largest obstacle to credible living wills might be mustering the political will to compel needed changes rather than defaulting to continued dependence on government backstops. Another useful step toward financial stability would be to critically re-examine the bankruptcy code itself, look for better ways to adapt it to the business of large financial firms, particularly those that rely heavily on short-term funding to finance longer-term assets. And Such work is actually underway here under the resolution project of the Hoover Institute with Ken Scott and Darrell Duffy, Emily Warren, other scholars, and other scholars across the country. Legal scholars are looking at this. And these reforms they've proposed are, which include a new chapter in the bankruptcy code specifically adapted to large financial institutions. These are compelling and worthy of serious consideration. I think they've identified some very important things we need to do. A third step towards financial stability is to identify legal or regulatory impediments to private sector arrangements that would reduce instability. So a big example is money market mutual funds. And I won't go into the details, but right now rules prevent them from structuring themselves in a way that would make them less fragile and less vulnerable to runs. And I think we should eliminate regulations that artificially prevent them from doing something that would make them more stable. Now, a final step may be required before financial stability can be assured. Market participants must have well-anchored expectations that government-funded rescues will not be forthcoming. Ideally, policymakers would act consistently in a manner that conforms to those expectations. But in turbulent times, as we've seen, it may be tempting to put urgent short-run considerations ahead of the need to preserve a record of precedents that keep those market expectations well anchored. Complete credibility of a commitment to forego rescues may be difficult if regulators retain discretionary authority to intervene. This is a particular danger for central banks like the Federal Reserve, who has independent control of its balance sheet, and we don't have to go through the congressional appropriations process. Our independent balance sheet places our fiscal actions beyond the scope of the legislative process. Credible commitment to orderly, unassisted resolutions thus might require eliminating the government's ability to provide ad hoc rescues. This would mean, for example, repealing the Federal Reserve's remaining emergency lending powers. And once robust and credible resolution plans in place, we would be able to responsibly wind down the FDIC's orderly liquidation authority and related financing mechanisms. So just to sum up, taken together, I think these actions can enable us to create a financial system where market participants don't expect government support, and thus they fund themselves responsibly. And where taxpayers aren't on the hook for institutions with the wrong incentives, but where financial institutions can effectively provide the services that a dynamic and innovative economy requires. This might be hard work, and from some vantage points it might even look impossible, but the alternative seems even less promising. The specter of an ever-increasing share of the financial system that is effectively guaranteed by taxpayers, and a never-ending sequence of financial crises. That prospect is unlikely to serve our country well, so I think we owe it to our citizens to do whatever it takes to achieve a financially stable system. Thank you very much for your attention.
Jeffy, if you want, you can stay there. You can sit down, whatever you like. So I was just going to ask you, what's your assessment of the stress tests that the banks go through? Is that reassuring, or do you think it's not that helpful?
I think the stress tests have been tremendously valuable and useful. Measuring capital at a big bank is sort of a rear view mirror type of exercise. We use accounting measures. It takes time for losses to be recognized and flow through to the accounting measures. And capital stress tests are a forward-looking process where we say, all right, over the next 24 months, what is your net worth going to look like in a scenario in which the economy turns out worse than we thought, and those last losses pile up? Are you still going to have the capital to be resilient, to not lose funding, to be able to keep lending in the economy? And so that kind of forward-looking measure of what the prospects for a firm are doing, I think is very important. So I think it's immensely valuable.
And related to that, I take it that there's a connection between the performance on these stress tests and the ability to pay dividends and basically pay out some capital.
Well, yes, what we do is they submit a capital plan to us, and that involves their plans for paying dividends, buying back shares, distributing capital, and the like. And we don't let them do that if they don't pass the test. If they're not going to be able to do that, and in an adverse scenario, retain enough capital to be a healthy bank.
So I think it's, I've been stalling for you guys. So let's start off with right here. Yeah.
My question relates to the role of transparency and using 20/20 hindsight, going back to look at what was going on in 2007, 2008. Part of what we saw was a securitization process that we'd never really seen before in terms of the slicing and dicing of these subprime mortgages and then folded into a security where nobody really was able to do any sort of effective or reasonable risk assessment of what they were buying. What do you see as what was the outcome of that absence of transparency, and how much did it impact the problems that ensued?
That's a good question, and people often point to sort of bad underwriting decisions by frontline people making mortgages, originating mortgages, and then the process by which pools of mortgages were put together into securities, rated by rating agencies, and then sold. So a couple of things to keep in mind here. One is that there were the ratings. So the ratings were used had an important use by regulators. We said if this is the rating, this is the capital you hold. If this is the rating, this is the capital you hold. So in some sense, we were a consumer. Now, if it was just a buyer and a seller of security, and that was all that was involved, I'd leave it to them and the rating agency to figure out, a rating process that makes them happy. But we're essentially have a tax that depends on the outcome of this rating, and so they had an incentive to game us. Both the buyer and the seller had an incentive to construct the riskiest possible security and still qualify for AA or whatever your target was. So I think regulators really fell down there in maintaining the credibility and integrity of the rating process. At the end of the day, more broadly, you look to the incentives, of people in the system, and there were some clear ways in which the incentives of participants in the housing finance market and the investors that were participating in that were distorted. A lot of the securities were sold downstream in Europe to investors that were essentially government-sponsored entities that had an incentive to reach for yield and maybe ignore the downside risk that you had to take on to get extra yield. In the U.S., of course, Fannie and Freddie were just notable and viewed as likely to be too big to fail. They're part of that 57% and the 45%. Their incentives to take on risk were distorted. And note that, when is it worthwhile to them and their investors for them to be viewed as too big to fail? Well, it's if there's a market-wide, a nationwide housing collapse, right? If it's just a regional collapse, they're not in the money. They lose a little money on some mortgages, but if it's nationwide, that's the kind of risk they have little incentive to guard against because it's sort of safety in numbers. There are a lot of ways in which the risks were distorted. I'll just say also that, the subprime losses came to the financial system. It could have handled it. A more resiliently constructed financial system could have weathered the storm of the losses that came out of subprime mortgages, if you look at the dollar amount. We just had a poorly constructed system going there.
Okay, yeah, here, and then Ann, you'll be next.
So where to start? I'm an economist, but I'm also a banker. So the economist in me understands everything that was said tonight, loves it. I know as a banker, most of the population does not understand this. So you started with creditor expectations. Let's put plain English on it. Part of those creditor expectations is the people who expect to see FDIC insurance on everything that they do. And it's a remarkable number of very sophisticated investors, whatever that means, who still want to see FDIC insurance. I understand the prescriptives that are out there, but what do we do to manage those expectations? Because it still seems to me that there's a vast number of people out there who think of banking as a utility.
That's an issue. I point out, though, that, so I didn't attack deposit insurance. I think a reasonably scaled deposit insurance system is a fine thing for a country. And I think of retail people with accounts, at banks as not the issue. The issue are money market mutual funds, institutional investors, hedge funds, who pulled their money out of institutions like Bear Stearns, where they had millions of dollars in positions where they were lending overnight collateralized by illiquid and hard-to-value securities. I think about those arrangements. And I think that's where the rub is, those wholesale funding markets. That's where the big issues are, and that's where the big fragility is. So completely agree that it's sort of two different worlds, and it's hard to reconcile what I've said with your perspectives on the retail investors.
So in terms of creditor expectations, you would not be talking about changing the expectations of the general funding.
No.
Ian?
I guess this is a natural follow-on. Notwithstanding the fragility that comes from the shadow banking world and money market funds, with regard to banks and some related financial institutions, there is an argument that is put forward and has some support from some folks in the community at Stanford that banks should simply have significantly higher capital, significantly higher equity capital. And would you comment on that?
So I think higher capital is a great idea. I don't know the magic number, but I'd point out that if you run out of it, the fact that you had a lot before is not much consolation. And we need a plan for what happens if we ran out of it.
Jim, and then straight back, but Jim Van Horn next.
I appreciate that your living will and the market discipline it will introduce would be good, particularly with the single bank failure. But when a financial panic comes, typically these claims are interrelated. You have hours and minutes to effectively deal with it, and you, as lender of last resort, have to stem a financial panic. So I do not see where this by itself will reduce the role of a lender of last resort.
Yeah, so a lot going on in that question. Numerous institutions in distress at the same time. So there's a couple of ways, scenarios in which that could happen. So if you've, if this firm is going to fail, or it's going to be bailed out, either way, you bail them out or they fail. Either way, you're sending a signal about their assets. So Bear Stearns, we learned something about their portfolio, that their assets were worth less than their liabilities. We learned that whether we bail them out or not. Bailing them out sends the message about whether we're going to bail out other people. So, but we can't avoid the information about their insolvency from getting out. That's unavoidable. And yes, that will cause people to revise their expectations about whether the guy down the street is insolvent or not. But I think the history of these panics, I think it, if you look at the 1800s, even in the Great Depression, they weren't willy-nilly. They weren't scattershot. They weren't random. They weren't blank. They were related to, there were areas where people had information that some firms some banks had incurred a bunch of losses that might bring them down. And so people were acting on information about what they were doing. And even if you have suspicions about a lot of firms, I don't think bailing them out is going to avoid the fact that those suspicions are going to be there. You're still going to have to deal with it.
So were you suggesting, obviously we don't know, but if Bear Stearns had not been bailed out, that Lehman could have taken actions so that it wouldn't have to be in such a situation?
I think all the big firms could have raised more capital over the summer of 2008, and I think they would have had an incentive to. They could have let short-term funding roll off. They could have funded themselves, termed out their funding as well. I think they could have taken a lot of measures, and I think the record with Lehman is pretty clear that expectations were they'd get support.
Straight back, yeah.
I'm curious about the solution here being something more about individuals and decision makers as opposed to an institutional solution that's predicated on more analysis, more model building, et cetera, more mathematics. It seems to me that every crisis we go through, it's all about let's change the analytic platform and let's look to the institution. But yet in all of these situations, the individuals have not had to face any consequences. And ultimately the moral hazard risk is an individual decisioning risk or a group of individual decisioning risks. And if you look across all the Wall Street firms today who were involved in the financial bailouts or who accepted bailout money, virtually all of the senior management teams are still in place, all the boards are in place, no accountability. They're all in a position to make exactly the same mistakes from a decisioning perspective again. And what I think much of this policy misses the point on is making individuals accountable for their decisions and making that the sort of key element to how to control risk in the future. Just curious about why we missed that point.
Well, I'm all about incentives. I couldn't agree more that altering the structure of incentives people face is the key to getting a different outcome. In this case, I'd assert that if those firms hadn't gotten the support they'd received, their outcomes could have been, the outcomes for the firms would likely have been more adverse, and I'd assert those senior managers wouldn't have done as well. Just a conjecture, but that seems reasonable to me. So I think you can, you could forgive a board or shareholders of a company that gets rescued and comes through when it should have been wound down. You can forgive them, I think, for failing to punish their senior leaders.
Yeah.
Well, so I mean, what do you expect the shareholder to do? We don't like the outcome, but if we've built in incentives and they've come through that way, fine. But I think in a different system, you'd get a different outcome, and you'd see more consequences for senior management. Is what I'd assert. That's what I'm saying. So I think we agree.
The next door neighbor to the last questioner.
Yes, ma'am.
You touched mostly on the regulatory front today. I'm wondering on the monetary policy front, that do you think the Federal Reserve's monetary policy, the very loose policy before the crisis, as well as the very unconventional policy after the crisis, also played a role in inducing excessive risk-taking within the financial markets? And more specifically, as Stanford economics professor John Taylor, he testified before the Congress today, and he called for a more rule-based monetary policy making. So I'm just wondering, in your view, are you in favor of or share his view on this? And are you in favor of more rule-based monetary policy as opposed to the current very discretionary monetary policy?
I think monetary policy makers should always strive to enhance the understanding of the public about the pattern of behavior they're going to display. How are they going to react to data in the future? How are they going to react as the economy unfolds, to different ways the economy could unfold? I think the more the public understands and is on the same wavelength with policymakers, the better. We can't pretend to know too much about the future, however, and that's the beauty of the simple rules that John Taylor has championed as lenses through which to interpret what central banks do. Now, they don't there's nuances they miss, but I think they're incredibly valuable, and I'm a major admirer of Professor Taylor as a result. Before the crisis is something that's going to get more research. To my mind, monetary policy is about inflation. And if you could fault monetary policy before the recession, it's because inflation from the beginning of 2004 to 2007 averaged 3%. And we were viewed as aiming at 2, and we didn't hit 2. And so on that ground, I understand an argument and endorse an argument that, yes, in hindsight, it looks like policy was too easy. Now, housing markets are another matter. We can achieve it if we stabilize inflation. Some markets are going to be up, some markets are going to be down. And I view the excess risk-taking in housing markets as driven largely by the moral hazard and microeconomic problems that I referenced earlier. So, yes, I'm a John Taylor fan. But I think the pre-recession policies, we need some more research on that.
Ken?
For any incentive system to work, the information has to become visible and exert its impact. When you're talking about declining asset prices, like the mortgage-backed securities, for example, accountants reflect that kind of thing with a substantial delay in balance sheets and 8Ks and 10Ks. Regulators come in and there's a similar lag. How can you get bad news reflected in market prices other than by requiring much more granular and detailed disclosure of bank portfolio positions so that market counterparties can do it without having to wait on the accountants and the regulators until it's long over the dam?
I think we could do more to improve what people understand about conditional large financial institutions. So broadly agree that there's been a presumption of secrecy, a presumption of proprietariness about financial institutions' information that's sort of a contrast with how we regulate some other things in our country and how the SEC treats firms that's under its purview. So yeah, I agree that more clarity. I think the stress test results are a great example of that. I think more detail about that would be useful to disclose as well. So I agree. Good point.
One last question in the back, then we'll call it an evening, early evening. Straight back. No, straight all the way back. I'm sorry.
As one who has used a great deal of bank credit and fortunately been able to repay it all, thank God, though there were some frightening days along the way, would you agree that the cause of the bust-in of most of these cycles is the excessive use of credit, and that the reason that the 2008 crash was not worse than it was that margin requirements in the public stock market were generally held at 50% or so, and that we didn't have overly excessive speculation in the public market in 2008 as we did when every elevator boy, taxi driver, and shoe shine shop boy was speculating in 1929.
Mm-hmm. I wasn't around in 1929. You may have been. So the relationship of credit to the business cycle is a debate that goes back centuries, and it's a tricky issue. Is it the dog or the tail? Is it driving the business cycle, or is it just what comes along with activity that goes up and goes down? That's a really interesting question. I tend to think of activity and credit as kind of being tied together at the hip, and you don't get expansions of one without expansions in the other. And so from that point of view, I don't view one as sort of being independently wagged by anybody in general. Now, when government policies distort credit markets, you can get activity that goes beyond where it should, and overshoots. And you can get overshooting even without bad policy as well. But so you're always going to see this correlation between credit and the economy. But they go together. There's some fundamental thing driving them both, rather than credit drives the economy or the economy drives credit. That's the way I think of it.
Well, I hope you interpret the situation as I do, and that is that the fact that we have an excess supply of questions is a reflection not only on the audience, but on the speaker. So thank you very much.